Hello, and thank you for joining. My name is Chris Cerimele, and this is a copy of a presentation that I gave at the 8th ICIS World Surfactants Conference on May 10th, 2018, and the topic is Mergers and Acquisitions, Megatrends Shaping the Future. A quick word about Balmoral. We are a specialist advisory firm based in Chicago. We have about 7 or 8 professionals, and we focus on corporate finance and mergers and acquisition advisory for mid-size and small companies in the chemical and industrial space. So I've been doing work in surfactants for a few years and am happy and was happy to have the opportunity to talk at this lecture. Now, I'm going to start by saying that I'm a deal guy, and this presentation is on market conditions. And this can be a very dry topic, much like an economics lecture. But I'm going to do my best to try and make this interesting. And so I'd like to begin by a short story about my life, just to tell you what it's like at the household of a deal guy. So I have a 10-year-old son. His name is Michael. And when he grows up, he wants to be a businessman like his father, which thrills me. I love this kid. And so giving you an example of what it's like at home when you have a deal maker, I was embarking on a 2-day trip and was going to be gone. And I had asked Michael to do a chore for me, some kind of cleanup in my home office. And I said to him, Michael, can you please get this done today? And he hemmed and he hawed and he said, no, Dad, I really don't feel like doing that today, but I'll do it tomorrow. Don't worry. And I was a little skeptical. So I said, okay, I'll tell you what, I'll make you a deal. If you do it tomorrow, I will pay you $5. If you don't and you wait till the next day, I'll only pay you $3. And after that, I'm not going to pay you anything. So we thought about this for a minute. And then he said to me, hey, Dad, but what if I do it today? So he's a clever little lad. And the moral of the story is this is the kind of thing that I have to do in my household. So anyway, enough on that. In my world, we're a small firm and we're usually more focused on the here and now. We deal in day-to-day negotiations and deals in the trenches. So it's nice to take a step back and look at the macro picture once in a while. And that's what I'm going to do today. So that my hope is that we'll all learn a few things. Now I'm going to begin by talking about global M&A trends across all sectors. We'll then drill down into the chemicals market. And in this presentation, I drilled down specifically into the surfactants market and specialty surfactants, because that was the topic of the presentation. But I could have easily done it on another topic within chemicals or something else. And you have to understand that just like with economics, the M&A market has macro trends, localized trends, and micro trends. So we're going to start with the broader trends. Now this page says that the global M&A market witnessed almost 40,000 deals in 2017, corresponding to a deal value of $3.5 billion. I'd like to make a note about statistics in this presentation before we go on. So how do we get this data? Well, it's based on a lot of self-reporting because very few M&A transactions are actually disclosed to the public. And even then, only a small number of those contain any measurable transaction data, such as purchase price, valuation, and etc. So I'll give you an example. If you take that $3.5 billion of deal value and divide it by the number of deals, then I believe it comes out to an average of around $89,000 per deal. And that seems low to me. And if it seems low to you too, then it's probably is too low. And it's probably because of missing gaps in the data. Many transactions are not disclosed, or people will say that they've done the transaction, but they won't give a transaction value, etc. So we do the best we can with the data. And what we find is that it's probably more useful to just look at the trends and not get too hung up on specific actual data. So you take it with a bit of a grain of salt, but it's still helpful. It's better than nothing. This chart provides a regional breakdown of M&A activity, and this is how most deal folks generally tend to segment the world. So when we have here the upper left quadrant shows North American deal activity, On the right, we have Europe. On the lower right, we have Asia Pacific, and the left, we have Latin America. And you see some boxes at the top above North America and Europe. What are those boxes? Well, that's average or typical multiple within that year, valuation multiples within that year. So for the US, for example, in 2017, the typical deal was done at 11.3 times EBITDA. So from this page, we can take a few general takeaways. First, if we start with Asia Pacific, you see that that region has the largest number of deals by volume, the largest amount of activity by volume. And then if we move up to Europe, Europe has had the largest increase in deal activity in 2017, owing primarily to improvements in the economic outlook. And on the left, you see that the US, although it's only third in size, the multiples of the deals are much higher than the other two regions. And so what we find is that what this means is simply that deals are more expensive in the United States. What can I say about Latin America? Well, it's very small. There's really not as much activity. There are some great Latin American firms, and many of them are active in M&A, but they're just unfortunately not as big of a factor as you might imagine. It's just overall a smaller economy. Now, turning to valuation trends, this is where it gets a little bit more interesting for someone like me, because it's not just the activity level, but how our valuation is trending. And what you can see here is that since the Great Recession, there has been a fairly consistent recovery in deal valuations. And again, I would caveat by saying that the data are not perfect, but it just does show general trends. And I would say that anecdotally, as a person who's in the market every day, these feel about right, at least directionally. So what I think of is that it's been a bull market in M&A for the last several years, and it continues to be a seller's market. Now, a note about private equity. Private equity continues to play a very strong role in M&A. As you can see from this slide, it was 20% of deal volume and almost 40% of overall deal value in 2017. It's even more important in the US. The US private equity market is very crowded. There's quite a lot of capital going into the market, and PE firms in general are very active. Now, despite that, this chart shows that there was actually a relative decline in private equity investing activity in 2017, going from about 8,800 transactions to 8,100 transactions. Now, this might look like PE is less interested in deal activity, but that's not really the case. Private equity is as active as competitive as ever, but the problem is that valuations are very strong, and there have been fewer quality assets on the market. After all, we've been in a 6-year bull market. A lot of the quality assets and quality companies were sold long ago, and that doesn't mean that the companies on the market now aren't high quality. It just means that there are fewer of them. And also, private equity is just having a much more difficult time being competitive. Now, this chart shows a bit about what I mean, because this is the approximate valuation that is being paid by private equity when they're doing deals. So when deals are getting done by private equity, they're getting done at very high levels. This means that in order for private equity firms to complete deals and feel comfortable that they're going to make a profit or an investment return, they're going to have a pretty good comfort level that they'll be able to generate growth or generate the kind of return that they'd be looking for. Remember, private equity firms in general look for about 20% plus internal rate of return every year. And so if you're going to pay 10.5 times or 10 plus times EBITDA for a business, you better be darn well sure that you've got a strategy that you feel comfortable is going to work. And if you don't have that strategy, then you're probably going to sit on the sidelines. Now, this chart is very important. Well, I shouldn't say chart. This slide is very important. In 2017, there were 372 private equity funds closed with an aggregate capital of $325 billion. Of that, the US accounted for about 250 of those firms. So what's happening is more money than ever is going into private equity, is being raised by private equity. There are also some dynamics that I won't cover in this presentation, but have to do with family office investing, wealthy family offices that have that traditionally would invest directly into private equity limited partnerships or alongside. And lately, over the past 3 or 4 years, what's been happening is that they've been bypassing private equity firms and have been investing directly. And what this means is that in addition to all of the private equity firms out there, you also have quite a few family offices that are competing for deals, and it just ratchets up the competition. Now, this chart is very interesting, and it really highlights my point about the fact that private equity, even though deal volume may have slowed a little bit, that they are very much in the game. So what this chart shows on the blue bars are dry powder. Now, what do we mean by dry powder? Dry powder is an M&A term or investor term that refers to the amount of capital that's sitting on the sidelines waiting to be invested. So this is cash in the bank burning a hole in the pockets of investors waiting to be put to use. So as of the end of 2017, there was $850 billion worth of dry powder. So this just gives you a sense that private equity firms are itching to make investments. The problem is valuations are high, good quality assets are relatively scarce, and so they're having difficulty finding the right opportunities. Now, I'll say a little bit here about some other macro trends that are impacting deal activity. I'm not going to pretend to be an expert in tax. I'm not going to pretend to be an expert in Asian politics or Asian policy. But what I would say that there are some things that are happening with U.S. tax reform, with increased outbound M&A from China, cross-sector convergence, and so forth, that are increasing overall activity. And on this page, what I'll say is that without being a tax expert, everyone has probably heard at this point about the tax plan that was passed at the beginning of 2018, which calls for a 21% reduction in U.S. corporate tax rates. From the perspective of a deal person, anytime you have a lowering of taxes, or I should say, anytime you have an improvement in earnings profile and earnings outlook for a business, that helps drive M&A activity, because again, it helps push the growth thesis. It helps people become more comfortable in paying a little bit more, but also from the seller's point of view, if taxes are lower, it's much easier for them to sell because they get hit with a lower tax burden. So overall, we would think that the tax situation in the US would encourage additional M&A, or at least encourage it to stay up. Now I'm going to turn to chemicals M&A. And this is a chart, this is a version of the page that I showed at the beginning of this presentation on global M&A. And you see here that global chemicals witnessed 1,100 M&A deals in 2017 with a total deal value of about 100 billion US. So remember, this compares to 40,000 deals and $3.5 billion. So the chemical sector accounts for about 3% of the global M&A market. It's not the biggest piece of the M&A market, but it's not completely insignificant. But what is interesting here is if you go back to the other slide where we said that the median EV to EBITDA multiple, so the median relative valuation multiple of deals in general was 9.5 times. And in the chemical sector, it's 10.2 times. So what this means is interesting is that even though chemicals is a small part of the market overall, the relative valuation of chemicals transactions is higher than the overall average by almost a full times of EBITDA. And I think this represents, higher barriers to entry for businesses, relatively more specialized specialty chemical businesses. There are a whole range of reasons why this could be the case. Here we have a measure of overall chemicals activity. And again, data is not perfect, but it's the best we have. And this shows an almost 50% jump in chemical activity in 2017. Why is this the case? Well, buyers are seeking higher growth through acquisition than they can get organically. The chemical market growth, organic growth is highly tied to overall GDP growth. I mean, chemicals is about a $3 trillion global industry, and it grows with GDP. And so companies that are looking for above average growth, above market growth, are increasingly turning to M&A to take advantage of growth in emerging markets or higher growth economies or global trends. This slide also shows that overall deal value has declined, as shown by the black line or the gray line. And this just means that there have been fewer mega deals. Now, keep in mind that 2016, you had Dow DuPont, and you had some others that were very big, and that number can be chunky when you're talking about big deals. But most buyers are focused on small and mid-sized deals anyway, and that's why we love the mid-market and the lower mid-market, because there's a lot of activity, there are a lot of transactions, there are a lot of deals, and so we don't worry as much about the mega deals. When the mega deals do happen, we're encouraged by it because it could provide opportunities for us. So for example, when a Dow and DuPont merges, just as an example, you would think that that might result in some divestitures, some reexamining the portfolios that could lead to opportunities for a firm like us to come in and advise on divestitures. Now, this slide is very interesting to me because this gives you the revaluation trend of chemical deals over time. And as with the global M&A market, it shows that there has been an increase in the last few years. For any deal of any meaningful size, and what we mean by that is generally at least 15 to 20 million of EBITDA, that's where these multiples would generally apply. There are some discounts compared to these numbers for smaller deals. And we do a lot of deals that are in the $5 or $6 million EBITDA range. So don't get me wrong, but it's just when you start to get smaller, you have a more risky business model, a more volatile business model, a smaller business. And so there can be a discount sometimes. But what this does show is that overall, valuations are as high as they've ever been. This chart just talks about private equity investing in chemicals. And as I mentioned before, private equity is not as important or active in the chemical sector. And so there are fewer deals, but there has been activity. Deal value overall has been increasing a little bit in recent years. But most of the private equity activity tends to be focused on specialty chemicals anyway. And that tends to be smaller transactions and a more limited market. This is the North American market for PE-backed chemicals M&A. And again, smaller numbers, but overall valuation trends are increasing. We probably get called at our firm, 3 or 4 times a month by firms we had never heard before that are saying, we'd like to introduce ourselves, we'd like to invest in chemicals, can we talk to you and be on your deal flow? Now, what drives M&A in the chemicals market? So you can really segment chemicals into a few subsectors, and from that you can look at where the most of the activity is. If we turn to this page, so the bottom bar, which is the big one, is commodity chemicals, and this tends to be the largest proportion of total activity because that's where the largest number of transactions are. I mean, commodities is by far the largest subsector of the chemicals market, followed by specialty, and specialty tends to be much more active in M&A because there's a lot more demand for specialty chemical companies. What we like about specialty chemical companies or specialty chemicals M&A is that is generally where you have the most buyer interest and buyer demand. When you're talking about commodity chemical companies and commodity transactions, those tend to be done between corporations that have large plants, and it's somebody who makes tons and tons and tons of chlorine is buying somebody else's chlorine plants, et cetera, things like that. Where you have specialties is where you have companies that have intellectual property, they have strong R&D departments, they have proprietary products, they have sustainable competitive advantages that allow them to price at above average types of margins or profits compared to commodity businesses. And they're not as cyclical and they're not as affected by sort of the ups and downs of global conditions and raw materials. So those are some of the reasons. There's more to it, but there's some of the reasons where specialty chemicals tend to be more highly valued and more active from a deal standpoint, from an advisor's perspective. Now, this chart talks about mega deal activity in chemicals M&A. And again, as I mentioned before, 2016, you would have had Dow and DuPont. 2017, you don't have as many. But again, this can be influenced largely by just the size of deals. I mean, mega deals, I believe mega deals in this chart are considered anything over $1 billion in value. That's a subjective number, but obviously if you have 5 deals at $1 billion each versus 5 deals at 20 billion each, that makes a big difference on these numbers. And we have seen in 2017 fewer really, really big mega deals. We don't rely on it too much as a barometer for our business because, again, the things that we're dealing with are smaller than that, and we're in a much more fragmented part of the market where there is far more deal activity. This page illustrates some of the reasons why mega deals have been increasing over recent years, despite the drop in 2017. But you've had relative valuations come up. You've had more mergers of equals, more reverse Morris trust types of things, engineered transactions, and on the right here, especially many more activist campaigns. Activist investors with public companies are becoming much more active in terms of pushing agendas related to M&A and portfolio optimization and diversification or rationalization. Now, in this presentation, we turn to surfactants in particular because of the nature of the presentation and the nature of the conference. M&A and surfactants really is witnessing similar dynamics affecting trends in the overall chemical industry. So I will go ahead and cover this, even though for many of the people who may be listening to this, it could be less specifically applicable. But just to give you a sense, because this also gives you a good idea of sort of general reasons for specialty chemical deals. And so you have on here, for example, Innospec acquiring Huntsman's European surfactants business, $200 million deal. You know, Innospec, for them, it expands their presence into new markets. It enhances their position in different, end markets. So expanding presence into geographic markets and enhancing presence in particular end markets. It was part of Huntsman's, portfolio rationalization. You see here Stepan acquiring BASF's plant in Mexico. It wasn't a core plant for BASF, and obviously it was highly strategic for Stepan. That one wasn't announced. The deal value wasn't announced, but these just gives you a sense for some of the reasons that these deals have been getting done. And this summarizes it also. It's you've got portfolio optimization from the larger companies. What is one company's mediocre performing business or non-core business is somebody else's strategic star. And so when you can line those up, it usually results in a pretty good outcome. Private equity firms really only invest in established companies. And so they're very active, part of their investment thesis. Because remember what I said, that the PE firms, in order to justify the high multiples that they're paying for businesses, they have to generate growth. And you're not going to get that growth just from organic efforts and internal efforts. You're almost certainly going to have to find M&A as a way to enhance that growth. And then the activist shareholders, which I talked about before. So I'm going to conclude. And, what I would say is that global M&A volume, as it says here, is anticipated to be consistent with previous years in 2018. The first quarter, just anecdotally, seemed like it was a little bit slower as we sort of deal guys are in the market talking about what deals are out there and what are on the market. There were fewer deals introduced in the first quarter, but then at the beginning of the second quarter, that seemed to have turned, and suddenly there are many more deals on the market. So what are some of the things that could influence this going forward? Well, nobody has a crystal ball, obviously, but What the M&A market really worries about the most is uncertainty. Because if you can't plan and you don't have a reliable forecast, then it's very difficult to put together any kind of a financial model that makes any sense. Because remember, in valuation and financial modeling, a big part of it has to do with forecasts, expected future performance, expected future cash flows. And so when you have uncertainty, that creates a lot of problems for folks. And so some of the things that could create uncertainty that could worry folks as I sit here in May of 2018, well, increasing interest rates, what impact could that have on things? As I sit here, the US administration the Trump administration has just pulled out of the Iran nuclear deal. That creates uncertainty. We have the discussions going on in North Korea. And I'm not making judgments on any of these things, but I'm just saying that it creates uncertainty. People are not sure what the impact is going to be. So this makes it difficult to know. But the fact is that people have talked about these kinds of things for the past 6 years, and we've had a 6-year bull market. So it's very possible that it could continue for another few years. It's just really difficult to say. So that's the end of my talk. This is my contact information. If you'd like to find out more or you'd like to have a chat, I'd be happy to talk more. If you have any feedback on this presentation, feel free. You can reach me in Chicago with the number here. And thank you very much again. And if you would like, you can download this presentation from our website. We also have some bonus slides. I'm going to just flip through them right now and just give you a sense for what we have in terms of bonus slides. So go to our website and feel free to check it out and give us a call. Thank you very much. Bye now.